A very pleasant good morning, everyone. My name is Richard Green. I'm director of the USC Lusk Center for Real Estate. And this is the 20th installment of Lusk Perspectives. Thank you for joining us. Just some ground rules. There is a Q&A box that you may type questions in during the presentation. Please have your questions there, not the chat room. It's just easier to follow them in the Q&A box. And what I will do is pass your questions along to our speaker, Connie Chan. Sometimes what I do is combine people's similar questions so I can get to as many questions as possible over the course of the hour. It's a great pleasure to welcome today Connie Chan. I first met Connie at a PropTech CEO summit in San Francisco about a year and a half ago, I think, something like that. Mm-hmm. And before I even knew who she was, she came across to me as an extraordinarily impressive person. And it's been my privilege to strike up a friendship with her in the time since. She is a partner with A16Z, Andreesen Horowitz, one of the best known venture capital firms in Silicon Valley. She has a background of Stanford degrees. We like her anyway. She has worked for Hewlett-Packard in China. She's worked at private equity firms previous to A16Z, and is sort of spearheading their work in taking property tech or taking tech to real estate. I'm not exactly sure what direction it goes. And we're going to do this a little differently from past Lusk Perspective series. We've had the speaker speak for about half an hour, and then we've opened it up for questions. Instead, Connie and I are going to have a conversation. And by the way, we just had a conversation online a couple of weeks ago when I joined her for an A16Z podcast where we talked about all manner of things involving housing. We're going to come back to that some. But I just want to start because I think a lot of our audience just doesn't know how VC has gotten involved in real estate space. So what does that involvement look like now, and how do you go about making your investment decisions when you look at that space? And again, Thank you for being here, Connie.
No, thank you so much for inviting me. I'm greatly honored to be here. I have been a huge fan of Lusk ever since meeting Richard. Just the perspectives, the data that Lusk brings to even my analysis is invaluable. So I'm a very, very big fan of Lusk. I'm very grateful to join you guys today. And in thinking about PropTech, PropTech is a fairly new phrase that's kind of showed up in Silicon Valley. I think it started getting popular actually in Europe first, about a year or two ago. Basically, venture capital has realized that real estate is really the largest sector, most interesting asset class in the world for us to really evaluate right now. And oftentimes in venture capital, when we're looking to make a decision, we're looking for three things. One is a very large total addressable market size. Two is a very strong team that has the right relevant background that we believe can capture a new opportunity. And three is the product. How big of a pain point are they solving? Are they gathering interesting data that can be used for other business models down the line? Real estate is one of the very few categories where I don't even have to think about the total addressable market. It's just a given that it's this massive. And I think that's a concept that a lot of venture capitalists have started to realize. The other big reason I think why venture capital is very interested in real estate is we've now also realized how much money flows through real estate. It's not just the purchase of a home, it's all the transactions that evolve around the house afterwards. It's the insurance, it's the mortgage, right? It's paying your landscaper, it's paying your cleaner. There are so many things that touch our physical worlds, whether it's in retail, commercial, residential, that with all of these money transactions, basically anything PropTech eventually can become FinTech. And that's also a very exciting opportunity, as FinTech has been another big sector of explosion from investment interest in the last couple of years. So when we look at deals, it's really evaluating those three things: the total addressable market, which in real estate, honestly, no matter how you slice it, whether you're commercial, retail, residential, I don't even think to size it because it is just that massive, as all of you know already. Team is a really interesting one. So historically, Silicon Valley venture capitalists would look for teams that largely were folks who had computer science backgrounds, people who are builders, people who are product managers, perhaps before at a Google or so forth. In prop tech, that's not always the case. Prop tech, as all of you know, is very nuanced, and oftentimes it helps to have folks who have lived the experience, who may have come from the real estate sector, who at the very least are homeowners or renters or landlords or have firsthand experience of the problems and the friction inside real estate. And so oftentimes the teams that we see do well in prop tech have both the technical background, but they also very importantly need to have some kind of industry understanding. It's not typically a sector where two young people straight out of college can go and make a big dent, because as you know, a lot of it revolves around partnerships, but more importantly, like a deep understanding of the true problems. And this is where I feel like a lot of prop tech investments, it's been really interesting to see how investors have evaluated them. The investors who have real estate experience themselves will look at deals very differently than those who actually barely touch real estate. And I think it's because real estate, as you guys know, is not purely a numbers game. There's also a lot of emotion, a lot of intangibles that factor into any decision about renting, buying a property, building a property, right? Is it on the right street corner? Is it facing the right direction? Does it sit next to a highway? A lot of things that are not just purely number crunching. And so understanding the emotions, even down to the impact of painting your door a bright color when you're selling the home. These are things that oftentimes only folks who have some kind of firsthand real estate experience will have. So when I look at teams in prop tech, I'm looking at kind of that marriage between technical know-how, but also true understanding or firsthand experience of the problems. And then 3, the big thing we look for is total addressable market, TAM, and then product. So product, meaning, is it solving a real problem? Is it creating something where there's a win-win scenario? Are people's incentives aligned to continue using a product or service in the long run? So those are kind of the 3 things that we use to evaluate pretty much any deal, not just in prop tech, but across the board: market size, team, and product.
So let me probe on a couple of those things. So let's talk a little more about team. And you talked about the importance of a mixture, if you're doing real estate, between the computer science side and the real estate side.
Yeah.
But I also would imagine that somebody who is a startup just needs to have a different kind of personality from other sorts of people. Do you evaluate that? So do you look at people who just have, so you have, for example, experience with HP. So that was sort of, you were part of a very large organization for a while. Is that a critical aspect of it? What are the attributes beyond sort of subject matter knowledge that you're looking for?
Yeah.
When you look at a team?
Personality in the team is very, very important, to the extent that when we evaluate the pitch, the final pitch where they have to pitch in front of all the general partners, that's typically a 45-minute pitch. We spend the first 10 to 15 minutes just probing the founder, just talking about the background, going all the way back to their childhood, for sure, talking about what they did in college, what did they major in, what did they decide to do after college, every single career decision. We never just jump straight into the product. And it's because the founder, to your point, is so critical to our decision making. And it's not just the know-how, it's not just the college degree. It's oftentimes what we gauge to be their grit and their conviction, and whether they have a growth mindset and can scale. So in some interesting ways, like if you came from a large enterprise company, a large corporate company, you might be very good at managing lots of people, but you might not be great at that 0 to 1 moment where you don't hire specialists, where you hire generalists, where you can't afford to pay someone 6 figures. And how do you then take talent that you're not used to managing, that maybe doesn't work the same way as your previous colleagues, and still get them to build an amazing product and service? So folks who come from big company have, they do have the benefit of knowing how to scale, how to have product cycle releases, how to have processes in place, but it doesn't mean that they necessarily can do the 0 to 1 phase. It's not a given that they can manage that, because that growth mindset is really what you're looking for. Someone who recognizes, hey, they maybe never have hired a head of sales before in their previous roles. They may never have had that experience where they had to hire a general counsel. Are these folks who are going to have what it takes to want to learn how to do all of those things down the line? So that kind of big company experience is nice to have and beneficial in the sense that you have more game film on how they perform in the workforce. Because as you guys know, the college degree is not a perfect predictor of necessarily how hard someone works or how much someone will stick something through once they start working. But at the same time, you also want that entrepreneur who is in some ways irrationally optimistic, because that 0 to 1 phase is very hard.
That's real estate development, by the way.
Yes. And so irrationally optimistic, where they have a view of the world and they have it so clear in their mind, and then they just start doing whatever it takes to get that world to become reality, even when not everything is working out. We talk a lot in venture capital about this concept called product market fit, which basically means you have a product that starts taking off, that the market is pulling for. And most companies actually never get there. And the few that do become very successful. But finding product market fit is tough, and it requires lots of experimentation. It requires trying out a product, building it, launching it, seeing it not take off, tweaking it, and rinsing and repeating that cycle. So finding an entrepreneur who can struggle through that, not give up on the idea, not give up on the dream, is something that we also look for. Now, I will caveat that with venture capital is a wide range of stage in terms of investing, right? You can invest on just a PowerPoint, on just the team. This person's an expert in this space. This person came from Slack, came from Stripe. Go ahead and give them a check. Or you can invest later stage, a series A, B, or C down the line when there's real numbers to work with. So of course, when we're looking a lot kind of at that personality, that ability to scale from 0 to 1, that especially is more important in the earlier stages of the business, where we feel like product market fit doesn't exist yet, maybe product doesn't even exist yet, and you don't have numbers to kind of back it up. And the reason why is also early on in that stage, that team is the team that you're betting on. It's not necessarily easy for them. They don't have the budget to go recruit that 6-figure executive again. They don't have the budget to go do that typically until they have something like a Series A under their belt.
Okay, your point about evaluating numbers as an investor versus you're working off the PowerPoint. I want to come back to that, so I'm trying to just say it out loud, okay, so I remind myself to come back.
Sure.
To that. But I
have invested off a PowerPoint before.
Right, but I also want to. But before I do that, I want to hit on your third point, which is about sort of the win-win opportunities.
Yeah.
And it seems like right now, in a time of COVID, there might be more of them than normal, because it's going to lead us to have to rethink certain aspects of how we do real estate. So, for example, are people going to be willing to buy real estate sight unseen? Or maybe that's not the right way to put it, touch unseen. They can see it online, but they can't actually go walk around in it. And you see these opportunities popping at the moment.
Yeah. And those kinds of win-win scenarios, especially the example you just talked about, a lot of times what we have to evaluate, and we may get it wrong, but what we're constantly trying to think through is this a behavior that will stick after COVID? Because during COVID, there's a bunch of areas where you saw huge demand surge or huge supply surge. And then the big question is this a behavior that will stick around well after COVID passes? And who knows when that will happen, right? We don't know when the vaccine will come at all. But that's a big thing that we're constantly thinking about, because there have been lots of sectors who have seen huge bumps during COVID, whether it is social sharing, telemedicine, online fitness, online education. All of these companies have grown dramatically during COVID. Sometimes the growth during COVID is more than the growth in like the last 3-4 years combined for many of these companies. So our big job is trying to figure out, is that kind of virtual tour of the home a behavior that consumers prefer, or one that they will want, even when the world comes back where they are able to go into the home, right? And I think for tours in particular, I think I'm still a little mixed on that one. I mean, having bought and sold homes before, I know walking the street is very critical, right? Like even when I do look at homes, I might type in the address in Google Maps and I'm looking around the neighborhood within a 1 mile radius to see, hey, am I next to a highway? What does the street sidewalk look like? How well is that street maintained? It tells you a lot of things beyond just looking in the home. Of course, all of that can be digitized too, and also be
I was going to say,
included in that virtual tour. Yes,
doesn't Google
you can
Street
include,
View largely do that for
yes,
you?
it does. It does. It does. But I will say, like, given the size and dollar amount of those purchases, at least I myself still prefer being able to touch and see the home in detail. Having renovated many homes myself, I know the quality of building materials varies dramatically, and can be covered through a lot of cosmetic things. And so unless that home tour is in such detail where I can tell, hey, is this engineer wood? Is this real wood? I feel like I would still be missing a lot of data points that would factor into such a very, very large purchase. On the flip side, I know I work with a lot of people in China, even in my role at Andreesen Horowitz, and I have lots of friends there in the venture capital community and also just personally. I know many people from China in the last 5 years who have bought homes in the States completely sight unseen. And for them, a lot of it is also an investment, right? They're buying it to rent out. They're buying it for their kids to live in potentially many years down the line, or for whatever reasons. And so I still think there will always be a group of people that are willing to buy homes sight unseen. And the question is, I think through COVID, has that behavior widened to the broader population?
Well, yeah. So what I was going to ask you, Connie, is my guess is your houses are a little idiosyncratic. They're not the typical 3-bedroom walkout ranch house. Is that a correct supposition?
Yes. Yeah.
And so what I'm wondering, so certainly it's the case that sort of at the upper end or the more idiosyncratic end of the market, and by that I mean weird in just the sense that it's not typical. That makes sense. But for, imagine going to a tract house in a suburb.
Yeah. Yeah.
Could that be a place where basically, houses they were built in the same vintage, they're built out the same materials, etc.
Sure.
You do have Google Street View to see if people mow their grass or not. Could that be a place where you actually do see people getting pretty comfortable with buying online?
I think it's possible, in the sense that I even hear about builders or realtors thinking about how to make it super transparent. Like if you're building a new house, you list out line by line, like what materials are going into the home. So the person has complete transparency. Or oftentimes, like even right now, when you look in a new home community, you look at the model home, the home you're buying is not even built yet. And so that behavior of buying already exists, right? Like you look at the model home, you see a big plot of land and you're like, okay, I'm buying that plot. It's going to look like this.
Yeah, and we had Adrian Foley who runs residential for Brookfield a few years ago, and he says that's exactly what they're doing. It's like not right nail by nail, but it's you know what your house is.
Right. So I think that definitely for new home builds, I think it makes complete sense. It's for the existing homes where I think there might still be some nuance. And the issue is, even if people are willing to buy things online, if it's a neighborhood they can get access to by driving there, by going there, I think they still will want to do that. I don't think it's one or the other. I think it's going to be one and the other. Basically, I may still do all the diligence in person, but now I'll be able to send that online link to my mother or to my other family members and say, hey guys, what do you think about this home? But I feel like if someone has the option and ability to go see the home in person for such a big purchase, for again, a lot of these people, this is such a big part of their personal net worth, that they're still going to do that, because at the end of the day, the neighbors still matter, the sunlight still matters, the parking situation on the street still matters. And so I don't see a world where people choose not to go see something in person. They may do that, I think, to filter out which homes they decide to go visit in person. But ultimately, if they can go in person, they're already doing that through Zillow, right?
Yeah.
So this will be an additional filter. And maybe I will be more strict on my Zillow searches and go actually only visit 2 homes instead of 5. but I'm still going to go visit those two homes in person if I can.
But so what about on the rental side of the market? And so this is one I actually have personal experience with when I spent my year working in the Obama administration.
Yeah.
I rented a place via Equity Residential Properties just online. So I just didn't want to bother. And it was great. And I kind of knew what an ERP apartment would look like. And it was right over a metro stop. So that's all I really cared about is it took me 8 minutes to get to work. And there you're not putting your own, it's still expensive, but it's not the same as investing. So could you see maybe the apartment market moving more toward a virtual world?
I think especially when you're moving into a city, so new city transplants, that makes complete sense to me. They don't have as much time to go fly into the city, see their rental stock available. And as you know, a lot of rentals, once you lock it in, your lease starts fairly shortly after. And so it's tricky to kind of fly in, find a place, have confidence you're going to get a good place in one day, and then plan already your move to happen the week right after. So moving into a city, I think for sure that can make a lot of sense. When you're just moving within a city, though, I still think, again, the neighborhood matters. And people may do things sight unseen, but again, it's if you can go in person to do that final check, to give you that sense of confidence, to know that your neighbor is not someone you won't get along with, I think people will still opt to do that. One thing I will say, though, that also changes the analysis is rental durations are also flexing with all of these startups that are getting into the rental market, right?
Oh, that's it. So tell us a little more about that.
So I mean, like you have the 1 year typical lease for a renter, but you also have a lot of startups that are doing furnished apartments that you can rent month by month, or for 3 months, or for 6 months. And there the commitment is even lower than if you're signing up to that 1 year lease, right? So the lower the commitment, the more willing I think someone is to rent sight unseen.
Are you seeing anything in the other direction? And this gets outside of tech, but one of the things that's mystified me for a long time is while commercial leases are typically 5 years or longer, residential leases, you can't get more than a year. And it's occurred to me and a lot of other people that one of the ways you could at least allow people to have more stability in their home is if they could sign a 5-year lease knowing that their rents would not get ratcheted up over that period of time. You seeing anybody trying to do that kind of thing in the market yet?
I haven't seen it at a startup, but I have seen it anecdotally.
Okay.
I mean, my mother, who doesn't want to deal with switching out new tenants, when she found a good tenant, she said, hey, will you sign a 2-year lease and lock in this price? And they did. And she's very happy with that. So I think anecdotally that behavior already happens. I haven't seen a startup go and do it. Of course, though, like historically, the rental markets have been very favorable. And so landlords didn't necessarily want to lock in a certain price for years at a time. And so things
that's true,
may change.
but they do it in the commercial market, and there is still a very large benefit to locking in a tenant, which is basically if you have a tenant rollout, even in a strong market, you're losing a month of revenue. So that's like an 8.5% drop in revenue,
right?
If you have to find somebody. So there's a real value to the security of having somebody in place for a longer period of time.
Yep.
And it just seems to me that's sort of an arbitrage in the market that nobody has in a systematic way solved yet. So, given that you're all about new ideas, I was curious whether you'd run across that. It is interesting to know, though, is on the point of is Hong Kong is the office market with the shortest lease terms. They're typically 2 to 3 years, and usually the tenants have to put in their own tenant improvements, and that reflects how incredibly hot that market has been.
Very supply constrained.
Yeah. Well, and just demand for Hong Kong has until recently been rising quite dramatically. Yeah. Let me talk about one other area of possible disintermediation, and it's always a bit of an uncomfortable one to talk about, particularly in front of a real estate audience, but that's brokerage. And, what we saw is tech sort of disintermediated travel. It's got to be 10, 15 years ago now. Yeah. Anyway, when Expedia and Obits and so came along, and basically the travel industry, the travel agent industry is a small fraction of what it was 10 or 15 years ago. Whereas when we look at real estate brokerage, we really don't see very much change yet at all. There's still a million realtors out there, for example. Is this a disintermediation that's just never going to happen? Or do you think people just haven't gone about doing it the right way yet?
Yeah, having lots of agent friends myself, and I think the very first Inman conference I went to was back in 2005. I think a lot of folks expected the realtor industry to be disintermediated by now, and it hasn't. In fact, the biggest rising brokerage is Compass, which is still in many ways very much a traditional brokerage by the way that they charge and by the features and services that they offer. So I think brokerages for real estate is going to have a different path than travel agents. And I think a lot of it is due to when you're buying that flight, it is very much a commodity. You know exactly where you're going. You know roughly what the plane is going to be like. You have a very good sense of the experience. And so the consumer's confidence that they can do this without anyone's help and they can just make the right decision if they saw all the options out there is very high. However, I think real estate, again, because so many homes are very nuanced, and again, it's such a large purchase, it's almost for that peace of mind that the buyer is still going to want an agent, especially when they don't perceive it as a cost to themselves. They think of it as a free service. And so in some ways, I feel like, yes, you're right that there's a lot new technology, and travel has been largely disintermediated. You really don't need travel agents for everyday personal travel. Real estate, one, due to the very large transaction dollar amount. Two, due to the fact that, again, buyers think of it as completely free and paid for, so why not get the extra help when you're looking at something that's complex, when even the inspection report, even the documents, the contracts you have to sign are things that normal people will be scared off by, I think. And three, the fact that realtors are both buying agents and selling agents. And so you're going to eventually interact with all kinds of agents, and such that if you create a new business model that kind of gets rid of one and penalizes one, but not the other, agents in general may still not accept that model. So I think what will happen instead is you're going to see an evolution of brokerages where there will still be companies or startups taking that typical brokerage fee, but they may have to offer a lot more services. They may have to be able to give you a loan to help you remodel your home. They may have to be your backup offer, so your offer is as good as cash. They may have to charge lower fees and basically be like a discount brokerage. They may have to offer you more compelling marketing materials, whatever it is. So I think the startups that enter the space are still going to be collecting a fee. Rather than you paying an individual agent, you're just paying a company instead. And the company's going to try and give resources to you that a single agent might not be able to provide.
So I want to come back to your comment about values and valuation. And this is to say, so the 0-1 thing I get, and there's just, you either think it's a good idea or you don't, and you decide to put some money behind it if you think it's a good idea. And you really don't have a specific NPV in mind for that particular company. And the way you guys and other VCs operate is you basically have a portfolio and you use diversification as a way to recognize that a lot of your calls are going to be wrong, but you have sufficiently large numbers of correct ones that you do very, very well.
Yeah.
Okay, so that's how it, but it's sort of that next level. And, you know, within real estate, there's a particularly spectacular example of this having gone wrong, which is what was called the valuation of WeWork versus what it came to be worth. And I mean, this audience will know, some of them anyway, that I started being very skeptical about WeWork when they first released financials, when they had a bond issuance in May of, I'm trying to remember now whether it was 2018 or 2019, but yeah, I think it was May of 2018. And I looked at their financials and I thought, no way that this company is worth, actually, I didn't think they were worth
Yeah.
anything.
You talked about this the first time I met you, so I
Did
can
I?
vouch that you've had this view for a long time. Yeah.
Yeah, and so, so there are people talking about this distinction between valuation and value, and that's something I've never been able to quite understand. So could you walk us through that a little bit?
Sure. Oftentimes, valuation, you'll hear this phrase, the company will grow into its valuation.
Yeah.
Meaning that you might put a price on it now that is well ahead of its progress, right? So rather than valuing it on its revenue today, you might take its revenue for the end of the year or for the next year, and say, if I applied traditional public market multiples on that future revenue, then it should be worth at least this. And it's a way kind of to justify paying a very high price today. Making the argument that you have confidence that this company is going to grow into that valuation, right? So in the case of something like a WeWork or a lot of those companies that had those similar models where they locked in these really long leases, they had a bigger story beyond just the lease, right? They had stories around going into residential or lifestyle, or building these communities within the offices and having digital interactions with all of the employees. And so the story was much broader than just the lease and release model that they ultimately were valued at the end of the day. So I'd say valuation and value, the main difference is, maybe value is what do the numbers pan out today if you applied public market valuations and revenue multiples. And valuation might be, what can this company become?
So I guess, so this is why, and we've had this conversation, why it seems like real estate to me is different from other stuff. So you have, you're early in the life of Microsoft, and you can see that they make an operating system that people really like, and it's really cheap to print more copies of that operating system.
Right.
Basically, every operating system that somebody buys is now pure profit, right? That's not quite true, but it's close to true. Whereas with real estate, you keep having to buy buildings or take on, it's a ton of a capital intensive industry. So you talked about scalability when we first started talking. Are there areas of real estate that you see as scalable?
Yes. There are definitely companies in real estate that are not necessarily capital intensive. Zillow being one of them, right? Before they kind of went into the iBuyer space, for them, every incremental home buyer doesn't cost them anything.
Yeah.
Right? And if you think about something like a VTS, a more modern example, every incremental customer for them, it's again a pure software play. So I think these pure software plays still exist in the real estate world too. And they generally exist around three areas. One is transparency to end consumer or discovery, and that's Zillow. Right? If I'm looking for a new place to rent, to buy, even on the commercial side, there's the Zillow equivalence there, right? So discovery is a big thing, which is typically software only many times. The other thing might be providing insights. So kind of being the vertical operating system for real estate, VTS being probably the most notable example. And that class of companies, if they can overtake, Excel, if they can overtake all the software you use to manage your day-to-day business. Actually, Yardi is the best example, really, in real estate, right? Super sticky, connects a lot of people in a very fragmented industry. At the end of the day, this is where you keep all of your data. If you think about all the data that Yardi has access to, they theoretically can give you all kinds of insights, right? Like if you have this asset, just say a residential asset, how much would you make if you put it on Airbnb? How much could you make if you rented it? How much could you make if you renovated and added another bedroom, and so forth? And so a company like a Yardi, I think, is a great example in the prop tech space, which again is not even the newest, latest cutting edge technology, right? The company is over 30 years old, and yet it has a fantastic business model, pure software. And the reason why tech is so powerful here is it's connecting a very fragmented industry and being, again, the source of knowledge, source of truth for a very valuable data that has historically sat in filing cabinets and and lots of papers and documents.
So, one of the things.
Oh, I would add one more thing.
Yeah, please.
There's another whole category of prop tech, which is around the lending space, right? Around mortgages, or refis or HELOCs. And they have a different capital constraint where it's not just the capital is needed to go buy or lease a place, but they need the capital to be able to lend it out. And so there's a whole crop of prop tech, fintech companies too. And their game is they have to go find cheaper sources of capital to make that number work.
Right, and that's where banks sort of have a locked-in advantage because deposits are a very cheap source of
exactly.
Competing against that is very difficult, right?
Yep. And so typically you go for the customer who gets rejected by the bank.
So let me take you in a couple of different directions, and then we'll get into audience questions. And again, if you have a question, please type them in the Q&A box. But first, something you and I have had conversations about is sort of the future of cities, and to the extent to which technology can be a substitute for cities. And now with COVID, people are talking about, maybe I don't want to live in a tall building with an elevator. Maybe I don't want to live in a crowded place. Maybe I don't want to take to work.
They're budgeting one bedroom as a home office, right?
Yeah.
They're thinking about how much space they need now.
Yeah. So how do you see, and this is something we're all thinking really hard about, but how do you see these things playing out? Now, and I'm not going to ask over 10 years, but over the next couple of years.
Actually, I think to answer the next couple of years is easier than answering the next 10 years.
Well, that's what I'm trying to be nice now.
Like the next 6 months, the next year, I do see people valuing the yard, valuing the bigger home over the proximity to their office, right? Like before, I knew lots of people who wanted to be focused on shrinking that commute time from 45 minutes or an hour down to 10 minutes, and they would pay the premium to live in a much, much smaller house to be close to their office. And COVID has really turned that on its head, where people feel no need now to live in the short term next to their office. And they very, very much value the yard space. They very much value the larger home. And so I'm even seeing that anecdotally, locally here. I know a bunch of people, even folks who lived in SF, who rented homes in Napa, or even in the middle of California, or even another state. And they're temporarily camping out in places where their money can go much further in terms of how much square footage they can get. So I think that in the near term is going to be a trend. But, going out long term, we have seen that the homes ultimately near centers of work, places where there's good education, places where jobs are being created, ultimately do tend to, rise in value and maintain their value. And so if historically we just look back at decades of how all around the world, not even just the US, I mean, Hong Kong and China, you see that even more extreme, where every single additional block or two, given the crazy traffic and congestion we've seen in those cities, really changes the valuation of that home. I'd say like in the US, even here around the 280 or the 101, these are the two major highways near me in the Bay Area. Sometimes if you think about, there was a period of time where either Palo Alto or San Francisco, for every highway exit difference, you maybe would add like another, several $100,000 to the valuation of the home. And that, if I looked at Beijing or Hong Kong, would not be a highway exit, but be more like 1 or 2 blocks. So historically, I think everything tells me that still being near the place where there's good schools, there's job creation, good hospitals, still is going to matter a lot in the long run. But in the short term, I do see people making that trade-off to have a more comfortable space, as a lot of them are not as worried about commute time. Commute time is something that I've been thinking a lot about because it does significantly change someone's general daily happiness. If you're commuting for an hour or 2 hours versus 10 minutes, it's a huge amount of time, and it really affects people's moods. And so historically, that's why I've been focused on also things like micromobility. We were the first investor in Lime, the scooter company, and that was a bet that congestion in major cities, not just here, but around the world, we're going to get increasingly bad.
Because you were telling me about Wuhan and how nobody is interested in getting an Uber and nobody's interested in getting on the subway. So they're all on Limes in Wuhan now.
Well, it's not in Wuhan. Wuhan is in the China version of Lime. The China version of Lime.
I was
teasing. Yes. The China version of scooters has done really well during the COVID. Spike actually was able to close a very large investor interest during that time, we think. So, basically during COVID, there is less of a desire to take public transportation and more of a desire to find alternate means of transportation. At the same time, you also don't necessarily have as many people going back to work. So it's also timed lockstep with lockdowns lifting. But this idea of wanting to live closer to work and schools and hospitals, ultimately, I still think 10 or 20 years is going to matter a lot. It's really in the short term, though, the 6 months, the 1 year, where people might make a different trade-off.
So one thing I think is still up in the air and will determine a lot about where people live, and tell me what you think about this, is it's pretty clear to me that on the one hand, managers are much more comfortable with people doing some work from home than they were before because they see that they get done. But on the other hand, people are still going to want to be in the office sometimes. And so if you think about it, imagine a world where people go to work 3 days. I mean, they're going to work every day, but they go to the office 3 days a week and work from home 2 days a week. That by itself should have a very salubrious effect on traffic.
Yes.
Right? And so that means people can live further away and have the same number of minutes commuting as before. And I don't know, it could be, we'll use the empty highway. You know, I'm channeling my inner Tony Downs when he'd say, people will figure out a way to use the empty highway space some other way. But I do wonder if this will fundamentally change things because of just, we're sort of we'll be time shifting things in a way that we didn't before.
I think it's possible, but I think the timeline is still potentially longer than people expect. This same conversation I had years ago when people were saying autonomous driving is here, we can live in the hills, I can be resting, I can be napping while I'm driving to work. There is no need to live close to the office. And it's been many years since that promise was first stated, and that hasn't panned out yet. And I think people's behaviors ultimately are still hard to shift. And I think the story is also still out on whether or not employers ultimately are going to prefer remote work, right? As we hit the summer months, are people's efficiencies and happiness levels going to stay the same when they have to work at home and be in front of their computer all day long? Unclear. Right. First 1 or 2 months, when people are still saying, okay, we're doing this for the short term, I see the light at the end of the tunnel. As that light at the end of the tunnel gets further away, do people enjoy working at home in the same way? I think that stuff is still unclear. So the verdict, I think, from both the employer and the employee preference is still unknown. And therefore, I think the impact on commercial real estate, I think it's going to be negative, honestly, in the near term. But in terms of like how negative and how does that ultimately impact residential living choices, I think too early to say. But in the near term, I think commercial real estate is hit. And ultimately what that also means, if you do believe only half the office needs to go in the physical office, then you can have more tenants per building, or perhaps you just don't need as much office space in that area.
Right. Well, and the other thing though is until we get a vaccine, social distancing is going to require using more space per employee. So,
right.
So the amount of space you may use may not.
And I think what you mentioned on the elevators is really interesting too, right?
Yeah. Let me turn to some audience questions. So from James, I'm very interested in the intersection of prop tech and addressing extremely affordable housing.
Okay.
Specifically addressing the homeless problem, leveraging technology. Who is innovating in this space?
Specifically addressing homelessness, I actually was just reading a pitch deck from a company that's trying to tackle this. It's not, the amount of technology is kind of light, but this particular entrepreneur, his bet is that rather than having small centers across a city, you should have one mega center, almost like a small city dedicated to building all these services and homes for the homeless. That company, though, I would say is not necessarily like a technology software company, but more just like a startup that I do believe is trying to tackle this. I've also seen some startups try and tackle more affordable kind of prop up temporary housing and temporary shelter. The tricky thing with a lot of them is, unfortunately, they've been met with significant regulatory limitations, where somehow if they create something that doesn't also include X, Y, and Z that the city would mandate them to have, they aren't able to get it out there, even though it's a huge improvement to the tent or the living structures that a lot of homeless have to live in today. So I think for homelessness, the issue has been, a lot of it is honestly bureaucratic. And also the whole issue of the not in my backyard is a very real issue. And so whatever solution you put out there, you do eventually need that community buy-in, that city buy-in. And so for that kind of startup, unless the startup has some ability to get around it, or have the buy-in from the community and the city, we haven't seen solutions that have kind of been able to do that yet at scale.
So the other question along these lines is, to what extent could technology be used to just reduce the cost of construction? And, Katera being...
Yeah. Lots of modular construction startups being created right now, a bunch in the ADU space in particular, where they feel like they can kind of standardize what that look and feel of the home could be in everyone's backyard. So I think there is a lot of talk around modular building, around building walls where the electric stuff is already all built into the wall, so that when you kind of put it on site, it's like Lego pieces, much faster put together. So lots of startups trying to tackle that. I'd say right now there hasn't been kind of like one standard that has really won everyone over just yet. So there have been multiple companies that are all kind of in that seed or Series A stage, where they each have their own design that they can build at scale for a lower cost.
So do you have any sense why? So, Singapore, they're doing this. And, they have factories in Malaysia. They build the modular units, and an apartment will take like 3 of these guys, just, boom, boom, boom. You put them together, you have them. And so in Singapore, which is a very, by the way, there's no labor cost savings for anything in Singapore. Is a very expensive place. And they're delivering units for about $170,000 US.
Yeah.
Why can't we do that? Are they just smarter than we are?
Well, as you know, Singapore, they build up, right? They have lots of land limitations. And so I think that's really different than when you're building wide and you're building like single family homes. So one, in terms of just user preference, when you are building things like a single family home, they vary much more. I think people, when you're picking a single family home on design,
when they say they have a standard model, they have a standard model.
Yeah. It's like, it's very standard. This is the number of bedrooms. This is the exact model of what the house looks like when you go in. And users, for the sake of being near a particular neighborhood, being near their office, or hitting a certain price point, they're fine with that. But in the States, when you're building oftentimes single family homes that are sprawled across, going across as opposed to going vertical, then you have, again, all that personal preference, which is why I think real estate, there's so much emotion at the end of the day involved, right? They have homeowners who, they care about what color their cabinet is. And the land, because they're different shapes, the plots are not all cookie cutter squares or rectangles. You have different issues around even getting that land prepped and ready and flat for that modular house to sit on top of it. So there's just many more factors that come into play, a big chunk of which is consumer preference, which is why I don't necessarily think it's going to be a winner take all, even though you see all these startups out there. You have startups that have homes that are extremely modern in design. And you have startups that are saying, hey, maybe people don't want that big box, modern, open space where from the kitchen I can see the living room, I can see the front door. People's preferences on the actual home design, privacy constraints, number of bedrooms, I think still varies a lot.
So we have a question from Graham Wahlberg, who I think he wants to make a pitch to you, but he says, so why combine?
I'd love to hear it. Please find me on LinkedIn.
Well, no, exactly. He just says, what are the prop ideas? So he wants to know this so he can make a pitch to you about one of them. What are the prop tech ideas you'd like to fund?
Yeah, so I think again, things that have are part of the transaction in some way. Transaction not necessarily meaning buying the home though, but anything that has money flowing, whether it's the rent or the payment to to again the pool cleaner or to your broker or anyone. That's always interesting because automatically you have a transaction that's baked in where you can kind of charge a service fee or something on top of that. I also like companies that have access to really valuable data. Again, the data that Yardi has can be used for all kinds of insights to their end consumer, and that data ultimately is their moat. It is the theory of defensibility for why another startup can't just come in and get that customer to switch over right away. And so access to interesting data, something that's kind of bringing together a fragmented audience, bringing multiple people together versus like a single player mode experience is also very interesting. Of course, you do have lots of single player experience type prop tech startups that are still big. But if you are touching upon something that brings multiple people together, that tends to be more sticky. And oftentimes when you're looking at a startup, you want something that people are not just using once and then they're done with it, unless it's like a huge transaction and you can really make a lot of money off that lead or transaction fee. You ideally want something that someone will be using 6 months, 12 months down the line. So when we look at startups, we often are looking at these things, what we call retention curves, cohort curves, which basically says, okay, month one, you have 100% of your users. How many of them still log into your website or app 6 months from now? How many of them still log into your app 12 months from now? And the reason why that retention matters so much is in this day and age where we spend so much of our time on just a handful of consumer apps, to be able to constantly pour new users into that funnel is tricky, right? Oftentimes it's done by paying up for ads, whether it's through influencer ads or just direct Facebook or Google ads. And so you don't want this leaky bucket effect where all the users that you pour in eventually leave in 1 or 2 months, unless you were able to monetize them in that 1 or 2 month time frame. So we're looking for things that can, again, bring people together, ideally have some kind of money flowing through it. But ultimately, I'm looking for something that solves a major pain point. Ultimately, something where the end user, whether it's a renter, landlord, owner, builder, has a real pain point that technology can solve. We talk about vitamins versus painkillers. Has to be a big pain point, right? You want to invest in the painkiller more so than the vitamin.
Along those lines, a couple of years ago, we had at our retreat, a couple of guys we had a panel on blockchain. And we had people saying title insurance was going to go away and we were going to make the transaction. Just so much, again, of the pain points in the transaction go away and some of the costs because of blockchain. I actually haven't heard too much about that recently. Has this sort of died down, or are we in a quiet period and it's going to come roaring back? What's going on?
Yeah, I think we're in a building period for crypto, right? So right now, like when you talk to an average person who owns Bitcoin, why do they own it? A lot of it still is they're thinking of it almost like an investment, almost like a stock, right? Like they're looking for the appreciation value and that's why they're holding it. And so I think right now people are still in the building phase where there can be more use cases of Bitcoin, and ultimately it'll take more building and more of these kind of bigger use cases to arrive for everyday people to start treating Bitcoin more like a currency. So I think we're still early in that building phase.
So because we're coming up on the top of the hour, I'm going to combine the last two questions together and sort of,
Sure.
and they're about, are you concerned about the following? One, are you concerned that Amazon is just going to be everything? And two, are you concerned that privacy regulations are going to inhibit, and in the examples Matthew Moore used, and it was Mark Renard who asked about Amazon, Placer and Uber Media, as we have more privacy regulations, is that going to inhibit the ability of some of these tech firms to grow?
Okay. The first one about Amazon, I personally am a big Amazon fan. I use an Amazon credit card. I buy way too many things on Amazon. But I also have heard, on Amazon, you can even buy houses. for $20,000, $30,000, these small houses that I think get shipped to you. And I know they're doing more in real estate. I think for them, it's probably still exploratory or very early days in how they're thinking of prop tech, to my knowledge. But you'd have to talk to them about it. In terms of, am I worried about them doing everything? The answer is no, not yet. I do think ultimately Amazon does bring a lot of benefits to end consumers. I'd say during COVID, if people didn't have access to shopping on Amazon, the majority of consumers would have a harder time and have to put themselves at risk much more going into stores to buy things, and most likely paying higher prices and looking at lower selection. So at the end of the day, I do still think that Amazon is a service that does help the majority of consumers out there. In terms of privacy regulations on mobile phone, privacy as just a broad topic, I think, is something that Silicon Valley has had to think a lot more about in the last year or two, especially if you look at things like GDPR hitting Europe. However, I don't think it necessarily hinders innovation. There's still a lot of innovation that can happen even with all of these regulations in place. So I don't see it as something that's going to be a massive hindrance to innovation.
So we are coming up on the top of the hour, and so I'm sorry, there's a question where it's going to be left unanswered. I'm sorry to the audience, but we do try to end these promptly. Connie Chan, it's always so much fun to talk to you. Thank you for joining us.
Likewise.
Thank you again, everybody, for coming, and we'll see you in 2 weeks. Connie, thank you again.
Thanks a lot. Have a great day, everyone.
All right. Bye-bye.
Bye.